I would like to move on now to the next session. So it's Peter Mulroy, Secretary General, FCI, and I'm really delighted to welcome you this morning. So you will give an overview of the global factoring scene. So before the crisis, the volume of receivables finance enjoyed a constant growth trend from 2012 to 2019, and factoring even had an accelerated growth after the financial crisis in 2008, 2009. So in the years before, in the COVID-19 crisis, had led to a significant decline in business volume. So we will hear what was the impact on the factoring industry, but not only that, the challenges now to support restarting business and growth. So you're on stage, Peter Mulroy, so thank you very much, and up to you.
Thank you, Robert, and great to see you. I hope you can hear me okay and see me okay. So distinguished guests, ladies and gentlemen, I'm pleased and honored to present this presentation on the overview of the global factoring scene at this 2021 SCHUMANN Conference. I want to focus on a few key topics during the next 15 minutes. I also want to thank Robert and Teresa for their kind invitation to talk today. I'll cover just a few things. One, what happened this past year? How did our industry perform? Where are we today? Are there signs of recovery? And lastly, what's in our crystal ball? So let me start with the, and I'm going to try to move from slide to slide, and I'm hitting the, I'm supposedly in control. So let's see here. Yes, now it's working. Okay, so obviously this past year has been one for the record books. You can see that the industry has grown on a compounded annual growth basis of 7% annually. This is down from 9% compounded over the last 20 years, but due to the significant drop in volume in 2020, which I'm going to talk about in a minute. But looking closer at last year's figures, the 2020 world factoring statistics indicates that the industry volume witnessed a period of retraction. And I'm going to show you that now. You can see here that the industry declined, in fact, by 6.5% in 2020. Now, ladies and gentlemen, the last time the industry experienced such a drop in volume was in 2009, during the height of the financial crisis, when the industry lost 3% in global volume, roughly 35 billion euros in volume lost. This decrease in global volume in 2020 of nearly 200 billion is 5 times worse than what transpired a decade ago, and represents the biggest drop in factoring volume ever recorded since FCI began accumulating global statistics on our industry 40 years ago. Now, yes, excellent. Total international volume also declined last year, but as a percentage of the total, it maintained its 19% position, and domestic volume remained at 81%. One other interesting observation to the right is the rise of non-recourse factoring. This non-recourse factoring as a percentage of the total has been on the rise for the past 20 years. But if you compare this figure with 2019, the share percentage increased from 42% to 55% in 2020. Again, the biggest single increase ever reported. Another interesting phenomena is a reported reduction in reverse factoring in 2020. Now, most of the largest banks in the United States and in Europe that are engaged in supply chain finance, reverse factoring, reported in some cases double-digit growth in business volume last year. So one of the biggest bright spots, in fact, for our sector. However, FCI announced amongst our members, so FCI members, that reverse factoring, in fact, showed a significant decline in 2020, mainly due to a large reduction reported in China. It is true most supply chain finance programs focused on investment-rated credits and target their larger supplier base. However, many of our members' programs also drill down the risk ladder, targeting non-investment rated credits and providing liquidity to SMEs and the suppliers in the long tail of the supply chain. It is well known that SMEs suffered far greater than larger corporates during this pandemic. Now, I'm just going to talk a little bit about the regional performance. In terms of Europe, the largest contributor, accounting for 68% of the total volume reported, however, showed a decline of nearly 7% last year. Of the largest markets, Germany fared by far the best, which reported flat growth. In fact, the Netherlands actually did a little better with a 1% increase. The UK, unfortunately, performed the worst, a drop of over 17%, followed by Italy at minus 11% and France minus 7%. Spain actually fared a little better, with showing only a decline of minus 2%. Now, I'm going to switch to the next slide just due to time. Asia Pacific represents approximately 26% of the global volume, and it experienced actually an increase of volume a little over 1%, one of the few regions to show growth last year. Now, this was driven by, as you can see, a resilient China, which reported a 7% growth in their total volume last year. Japan also witnessed a increase of actually 3%. However, most of the other largest markets in Asia reported declines. Hong Kong minus 5%, Taiwan minus 12%, but Singapore fared the worst with a reported decline of minus 23%. Now, I'm going to go to the Americas. The Americas, certainly the hardest hit region globally, declined by a staggering 30%. And in terms of market share, their market share combined was around 8% in 2019. That dropped to 5% in 2020. South and Central America witnessed a staggering decline, really the worst hit region, of 37%. Driven by declines in Brazil, a minus 59%, Chile minus 20%, Mexico minus 43%, and Colombia minus 28%. However, Peru fared actually much better than those others, with a reported decline of only minus 2%. But please note that these figures are reported in euros. And these declines were also driven by a steep depreciation in most currencies in 2020 in Latin America. North America also was hit hard, showing a minus 23% decline compared to 2019. This was driven in large part by the significant spike in retail bankruptcies there, and the impact on debtor lines and the retrenchment by the credit insurance sector in the US market. Now, I'm just going to go lastly to Africa. Africa, which actually has grown nicely over the past few years, continued its positive trajectory, reporting a slight growth in volume in 2020, representing a 3% increase. This shocked me, quite frankly. South Africa showed the largest decrease in GDP in the second quarter of 2020, minus 53%. So I was anticipating a really steep decline in volumes there. Now, granted, again, all of these figures that I show you today are all reported in euros. So with the exception of the Eurozone, most currencies did depreciate against the euro last year. Okay, so what are we seeing today? Let's just go. Yeah, what are we seeing today, and what are the signs of recovery? So I'm just going to show you just a quick slide on inflation. And in general, productivity is surging. There's no surprise there. Sectors all across the global economy in the first half of 2021. And with inflation on the rise, as you can see, it is only a matter of time that interest rates will follow suit. But look at the chart on the right, vaccination distribution as a percentage of the population. And you can see the obvious repercussions. Recoveries will be curtailed in these emerging markets in comparison to the developed ones. As such, factoring figures as well in these markets will be adversely impacted. You know, it's interesting. FCI has onboarded approximately 150 members just in the past few years, of which 70% are coming from these emerging markets. Hence, I'm afraid that many, especially some of the newest markets that have just launched factoring, will be adversely impacted in the short term. Now, I want to show you a slide that I prepared on the various markets in the world in the first half of 2021. These are selected figures from our members. And you can see that we are witnessing significant recovery in the first half of the year in the factoring industry in general. You can see the negative territory line. Most of the markets, most of the companies reported are in the positive territory. In continental Europe, the word is quite positive reports of growth in places like Germany up 8%, Spain up 7%, Italy up 12%. Even in the UK, that suffered considerably last year, as I previously mentioned, shows a growth of 17% in the first half of 2021. In the US, one factor reports an increase in volume of over 30%. In Russia, the industry reported a growth of 15%, and South Africa increased approximately by 17% in the first half, from what I'm hearing from the members. In China, the China Banking Authority reported an increase of nearly 50% in volume of the factoring industry there. That all being said, the stimulus programs are still having some adverse impact on funds in use in our industry, as companies are lured by the lower costs associated with such government programs, especially in the UK and the US. Now, I just want to show you just a brief slide about an interesting phenomena from our industry that we saw relating to dilution and past dues. And you can see here, dilution and fraud risk also increased last year as a result of the pandemic. Past dues increased by over 160% during the peak of the crisis, and dilution risk increased nearly 40%. Despite these challenges, the industry got through the worst of it, thanks in great part to these government stimulus programs. Combined with the launch of the global vaccination programs earlier this year, we're beginning to see a significant improvement in these figures, as you can see. In fact, I'm seeing in both past dues and in dilution rate, levels that I've never seen before, ever reported in the 20 years that I've been following these statistics quite closely. Now, I want to turn to the Edifactoring report. This is just showing how Edifactoring volumes, and that's the volumes done on an international basis between the FCI members. And you can see this slide does show a volume for the first 8 months of the year 2021, ending in August. And this compares to the same 8 months in 2019 and 2020. We took hits, you can see, in both 2019 and 2020 as of August, stemming first from the trade war, which significantly hurted cross-border volumes, hit global trade and trade finance in general, and of course in 2020 to COVID-19. However, we ended up in 2019 with a small increase of volume of 1.2%. And even though 2020 was a very challenging year, not only due to COVID, but also stemming from significant reduction in commodity prices, the overall transaction volume for 2020 fell only by minus 19%. Fortunately, as we see the recovery around the world, including in commodity prices, we are now witnessing a significant rebound in 2021 as well in international, with a double-digit increase in international factoring volume as reported here in Edifactoring. So what's in the crystal ball? Let's go to the next slide. Right. Sorry. There we go. So what's in the crystal ball? And is fraud on the rise? One other stark observation that we gleaned from the FCI member survey that we conducted late last year was the precipitous rise in risk outlook. The negative perception of client risk increased from 12% in 2019 to over 24% in 2020 globally, and 12% to 28% in customer debtor risk outlook. Now, this is stemming from the end of these stimulus programs, the end of bankruptcy moratoriums, the rise in inflation, and the expected rise in interest rates as well, and stemming from the massive increase in government debts, with the expectation that there will be a rise in the tax rates that will altogether result in increased costs and risks in the system. Okay, so now we're going to show you just a few kind of things that happened this year. And you can now see, relating to advocacy, some of the things that we've been doing in FCI. But I want to first talk about Greensill. You can't talk about this period of this pandemic without talking about Greensill. As we've learned, the Greensill bankruptcy showed all of us that what can go wrong when industry bends the rules, manipulates well-founded structures that have been working for over a century, and is a warning sign to those investors and other arm's-length funds when proper due diligence fails. And the notion of relying on billions of dollars in exposure against a rather unknown credit insurer, I think, is another example of carelessness. Let's be honest, Greensill became the darling of Wall Street, businesses and governments alike. They didn't know what they were buying into. And there are other Greensills. Are there other Greensills on the horizon? The UK regulators just sent out a letter to the CEOs of the largest banks there, warning them of concerns that they have as it relates to how risk is being analyzed internally, stemming from this and other cases like, for example, the commodity fraud case in Singapore and Leon. We know that for those who get it right, they are aware what is happening underneath the hood of their car. But for those who do not, they will be subject to operational, concentration, dilution, fraud, and other risks. The other stark observation is the role rating agencies played, I may add once again, placing strong investment ratings on a structure that was in essence a house of cards. My friends, in our rather complex receivable structures, the backing of credit insurance alone is never enough. Now, during the second quarter of 2020, at the height of the pandemic, while U.S. bankruptcies were being reported nearly every week, FCI led an initiative to support the creation of a credit insurance shield in the U.S. to ensure their continued support to the industry. Together with ICISA, we had prepared a joint letter including the support of the major credit insurers to promote the formation of a credit insurance shield there in the U.S. It was sent to the U.S. Treasury, the Federal Reserve Bank, and the U.S. Department of Commerce. We received their acknowledgement and interest in the subject, but in part due to the upcoming elections last year, it did not get off the ground. Nevertheless, it was a worthwhile exercise and set up the concept of this in the future. By the way, FCI formed in 2016 a joint factoring credit insurance working group, which has met every year since. This SHIELD initiative is a direct result of this working group. Now, I want to talk a little bit about zombie companies and the risk of these zombie companies on the rise. One of the obvious risks for the factoring industry waiting around the corner is the rise of such companies. The stimulus programs in their various forms have protected such companies from COVID-19 related insolvencies. Organizations such as the Burn Union and ICISA have predicted a surge in claims in 2022 as these programs end. As a SAP report recently indicated, low interest rates have enabled these fragile businesses to accumulate more debt, thus increasing the risks that more of these unprofitable businesses become zombie companies. As such, many of these companies may be unable to repay their obligations as liquidity dries up, resulting in increased provisions by the financial sector, including the factoring community. And as interest rates rise, refinancing costs and thus profitability of zombie companies will be adversely impacted. Now, I want to just say, but on the bright side relating to advocacy, FCI partnered with the UNIDROIT to develop a new model law on factoring. This is the first attempt to develop a global UN-based model law for our industry. FCI was instrumental by supporting the model law's creation through an aggressive lobbying effort. And in May 2019, together with the support of the World Bank, the UNIDROIT approved the project. We are midway through it in its development, and we expect it to be launched in 2023. This will certainly be a game changer for our industry. Just to talk as well about a few other advocacy projects, I want to first mention the factoring law in Nigeria. You can see here in Nigeria, FCI was invited to attend a Senate Banking Commission hearing on the law in November 2020. In fact, the draft legislation was finally approved by the full Senate in February of this year. And I'm telling you, this will be a game changer for Nigeria. It's the largest economy in the continent, and it's part of the African Continental Free Trade Agreement. And we expect factoring to boom and excel as a result of this. Now, the Bangladesh Bank approved its first policy on international factoring in June 2020. That's after a nearly 10-year aggressive approach to making the central bank and the government aware of the benefits of factoring. And we were delighted to see finally the approval by the Bangladesh Bank. It will permit banks to finance against the assignment of export receivables and do international factoring. The FCI also was involved in the formation of a legal study. Now, the EUF, the European Union Federation, has for the last, I believe, 6 years, had embedded a legal study in the European Union countries. And it's great, and it's available to all FCI members as well. But there are an additional 70 countries that FCI services, and we wanted to also shine a light on these markets as well. So we launched this legal study. It's going to be hopefully available at the beginning of 2022. And lastly, China. FCI is looking at a project in China together with the China Banking Association to create a Chinese-based set of rules emulated after the GRIF, but specifically addressing domestic inter-China transactions, so covering domestic risk. We hope to have this project off the ground by the end of the year. And lastly, what's not on here, I just want to mention our Edifactoring project. FCI has also announced the launch of Edifactoring 2.0 and implementation to improve the entire experience for international factoring for our members. We're at the tail end of the development, and we're in testing phase. We'll look to implement the phase 2 of the project, which will add a blockchain component and also a seller-debtor onboarding component. Lastly, in conclusion, ladies and gentlemen, I just want to say that, where are we? Where are we heading? Factoring is in high demand right now as the crisis dissipates. We see the rebound occurring as reported by many of our members. In fact, if you assume that our industry size in all of its components is approximately $5 trillion today, which accounts for about 6% of global GDP, we estimate our industry will grow to over $10 trillion by 2030, accounting for nearly 10% of global GDP. And that's based on a very conservative 6% compounded annual growth rate over the next 10 years. But this will not come without its challenges, with the environment around us still quite in turmoil. However, factoring and receivables finance is an extremely resilient industry, as you all know, and no matter what, I anticipate bright skies ahead for our future. Thank you very much.
Fantastic. So thank you very much, Peter, for the fantastic overview. What we recognized is to evaluate the situation as it is. Of course, you need to look into each region, because the situation in each region differs, and of course also the prospects in the future to recover. I think that's a great overview. And another thing in talking about risk, I think you covered it greatly, that we are not talking about credit risk, we are also talking about fraud and the risk coming up. So that's something new. What is more significant, what we recognize as an outcome of the COVID-19, but maybe there were the first signs already before COVID-19, but now it is expressed and has a huge impact here. So fantastic. So the only question would be, of course, for people, what happens with the sales volume that was lost in 2020? How long does it take to recover and to compensate that? What is your estimation? So maybe only a short answer to this question. Will we see this extraordinary factoring volume increase as we saw that after the financial crisis?
Thank you, Robert. And yes, you saw the slide with the growth rates in the first half of 2021. I mean, we're already in the double-digit realm. So we're in a huge rebound. So if we end up the year obviously in a low double-digit figure, which I think maybe we will, or high single-digit, but it will be better than the decline. So we'll make up for the loss in 2020, in 2021 for sure.
Yes, so thank you very much, Peter.